Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of understanding bond yields and growing your money. Strategies to maximize returns based on bond yields. To maximize returns based on bond yields, investors can employ several strategies. One common approach is to ladder bond maturities, spreading investments across bonds with different maturity dates to balance risk and return. Another strategy is to reinvest bond yields by purchasing additional bonds, compounding returns over time. Additionally, investors can diversify their bond holdings to include a mix of government, corporate, and municipal bonds to optimize returns based on varying yields and risk levels. By incorporating bond yields into retirement planning, understanding the impact of economic factors on bond yields, and implementing strategies to maximize returns, individuals can build a resilient financial plan that supports their long-term financial goals. Bond yields can serve as a valuable financial tool when utilized effectively in financial planning, offering stability and growth potential in an investment portfolio. Current trends and future outlook. The world of bond yields is constantly evolving, impacted by a myriad of factors ranging from economic indicators to market sentiment. Understanding the current trends in bond yields and making informed predictions for the future can be crucial for making sound financial decisions. Let's delve into recent changes and future outlooks in the bond market. Recent changes in bond yields. In recent times, bond yields have experienced significant fluctuations, driven by global economic shifts and central bank policies. The COVID-19 pandemic, for instance, led to a surge in bond buying as investors sought safe haven assets, resulting in a downward pressure on yields. However, as economies recover and inflation expectations rise, bond yields have started to climb back up. The Federal Reserve's decisions on interest rates play a pivotal role in influencing bond yields. Any signals of potential rate hikes can cause bond prices to fall, leading to an increase in yields. Moreover, geopolitical events, such as trade tensions or political instability, can introduce unpredictability in bond markets, affecting yields in the process. Predictions for bond yields in the near future. Looking ahead, experts predict a mixed outlook for bond yields in the near future. With inflation concerns looming and central banks contemplating policy adjustments, there is a likelihood of bond yields continuing their upward trajectory. However, the pace of this increase and the extent to which yields will rise remain uncertain. Investors are advised to closely monitor economic indicators, such as GDP growth, employment figures, and inflation rates, to gauge the direction of bond yields. Additionally, staying informed about central bank announcements and geopolitical developments can provide valuable insights into the future movement of bond yields. As the bond market remains dynamic and responsive to a multitude of factors, adaptability and a keen eye on emerging trends are essential for navigating the evolving landscape of bond yields. By keeping a finger on the pulse of market dynamics and being proactive in assessing future scenarios, investors can position themselves strategically to capitalize on opportunities and mitigate risks in the bond market. Practical tips for managing bond yields. Balancing your investment portfolio based on bond yields is a critical strategy to ensure your financial health. By periodically reviewing and adjusting your portfolio in response to changing bond yields, you can optimize your returns and manage risks effectively. Rebalancing portfolios based on bond yields. Regularly monitoring bond yields and adjusting your portfolio allocation can help you maintain a diversified investment strategy. When bond yields fluctuate, it might be necessary to rebalance your portfolio by selling high-yield bonds and purchasing low-yield bonds to realign your risk exposure. Consider setting a predetermined threshold for bond yields in your portfolio allocation strategy. When bond yields surpass or fall below this threshold, it signals a trigger for rebalancing. This proactive approach can help you stay on top of market changes and make informed decisions to protect your investments. Utilizing bond yields for tax-efficient investing. Bond yields play a significant role in tax-efficient investing strategies. High-yield bonds tend to generate more taxable income, which can impact your overall tax liability. By strategically incorporating municipal bonds or tax-advantaged bond funds with lower yields into your portfolio, you can minimize the tax impact of your investment income. Explore tax loss harvesting opportunities to offset capital gains with losses from underperforming bond investments. This strategy can help you reduce your taxable income and optimize your after-tax returns. Consult with a tax advisor to develop a tax-efficient investment plan tailored to your financial goals and risk tolerance. Seeking professional advice on bond yields. Navigating the complexities of bond yields and their implications on your investment portfolio can be challenging. Consider seeking guidance from a financial advisor or investment professional with expertise in fixed income securities and bond markets. A knowledgeable professional can offer personalized insights and recommendations based on your financial situation and investment objectives. They can help you interpret bond yield trends, assess risk factors, and devise a strategic investment plan that aligns with your long-term goals. Remember that the guidance of a professional advisor can provide valuable clarity and confidence in managing your bond yields effectively. Stay informed, stay proactive, and seek expert advice to make informed decisions that support your financial well-being. Understanding bond yield is key for managing your money effectively. Whether you're a seasoned investor or just getting started, keeping an eye on bond yields can help you make better financial decisions. Bond yields influence the returns on your investment portfolio, impacting everything from savings accounts to retirement funds. Stay informed about how bond yields fluctuate with the market. By doing so, you can better anticipate changes that might affect your investments. Knowledge of bond yields equips you to adjust your financial strategies promptly, maximizing your gains and minimizing risks. Don't ignore this crucial aspect of financial management. Your future self will thank you for being proactive and well-informed. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Understanding bond yields is fundamental for investors looking to grow their wealth through fixed income securities. Bond yields indicate the return on investment an investor can expect from a bond, playing a pivotal role in shaping investment decisions and portfolio strategies. There are several types of bond yields, with current yield and yield to maturity, YTM, being the most prominent. Current yield is calculated by dividing the bond's annual coupon payment by its current market price. This metric gives a quick look at the income generated relative to the bond's price. However, it doesn't account for the total return if the bond is held until maturity, which is where YTM comes into play. Yield to maturity is a more comprehensive measure, considering the bond's current market price, its face value, the coupon interest payments, and the time remaining until maturity. YTM represents the internal rate of return if the bond is held until it matures, assuming all coupon payments are reinvested at the same rate. This makes YTM a crucial tool for comparing bonds with different maturities and coupon rates. The relationship between bond prices and yields is inverse. When market interest rates rise, the price of existing bonds falls because newer bonds are likely to offer higher yields, making them more attractive. Conversely, when interest rates fall, the price of existing bonds increases as their relatively higher coupon rates become more desirable. Understanding this relationship helps investors anticipate how changes in interest rates can impact their bond investments. Inflation is another critical factor influencing bond yields. Inflation reduces the purchasing power of a bond's future cash flows, making them less valuable. To compensate, investors typically demand higher yields during periods of rising inflation. Conversely, during periods of low inflation, bond yields tend to be lower as the purchasing power of future payments remains more stable. Different types of bonds have varying yield characteristics and risk profiles. Government bonds, such as U.S. Treasuries, are generally seen as low-risk investments, backed by the government's credit. Consequently, they offer lower yields compared to corporate bonds, which come with higher default risk. Municipal bonds, issued by state and local governments, often offer tax-exempt interest, making them attractive for investors in higher tax brackets, potentially enhancing their effective yield. Investors can use bond yields to build diversified portfolios that balance income generation and risk management. For example, short-term bonds typically offer lower yields but provide greater stability and lower interest rate risk. Long-term bonds, while offering higher yields, are more susceptible to interest rate fluctuations. By combining bonds of various maturities and credit qualities, investors can achieve a mix that aligns with their risk tolerance and income needs. Bond yields also serve as important economic indicators. Rising yields often reflect expectations of stronger economic growth and higher inflation, while falling yields may signal economic slowdown and lower inflation expectations. By monitoring bond yields, investors can gain insights into broader economic trends and adjust their investment strategies accordingly. Moreover, the shape of the yield curve, which plots bond yields across different maturities, provides valuable information about market expectations. A steepening yield curve typically indicates expectations of stronger future economic growth and higher inflation, whereas an inverted yield curve, where short-term yields are higher than long-term yields, can be a predictor of economic recession. Understanding bond yields involves more than just knowing the returns. It requires a grasp of the broader economic context and the specific characteristics of different types of bonds. By leveraging this knowledge, investors can enhance their portfolios, optimize their risk-return profiles, and ultimately grow their wealth more effectively. Through careful analysis and strategic allocation, bonds can play a vital role in achieving financial stability and growth. Subscribe, like, and share to continue your journey to financial success.